Erik, welcome to the show.
Thank you, Paul. Thank you, Tim. Thanks for the invite.
Well, it's great to have you on. As I say, we had a listener who was really interested in what you were saying, and I've listened to some of your material, and it is really good. So it's great to have you on. I'm sure we're going to have a great chat. Just for our listeners who may not have heard of you before, could you give us a potted history of how you got into the markets and what you've been doing in the past and what you're doing now?
Yeah, sure. My background is I started out as a global banks analyst at a mutual fund company in San Francisco. Worked then for a few hedge funds, moved over to London in around 2002 because I thought if I was going to be a global financials analyst, I should be in a global financials capital. And I was mostly doing European banks. Then around 2009, I worked for a hedge fund that ended up shutting down and moved over to the sell side for 3 years. So worked as an equity salesperson for HSBC for 3 years in San Francisco. And then from about 2013 on, I ran an Africa fund for about 7 years, but which ended up closing down just for lack of investor interest, understandably. And since then, I've been doing some consulting for the asset management industry, but also writing a blog called YWR, which stands for Your Weekend Reading, and it was based on a desk note I used to write when I was at HSBC, when I was writing to my clients, and it was kind of popular. So I picked it up back in 2022, and so maybe that's where your listener came across me.
So this was something you used to write on a Friday. So was that a Friday for the weekend, sort of reading, that sort of thing?
Yes. The problem I was having was I was trying to break into these big clients in San Francisco, with the typical HSBC research, and it wasn't really working. So I was like, you know what? I'm going to write something like totally different and in my own view and be original and cut through this, and that just take a different approach. And that started to work, and so that I kept doing it. And yes, that was a Friday evening, the last thing I did of the week, and I would send it out. Yeah, and they would read it. I thought, well, let me send something when they don't get any other emails. And so, right, Friday night, I was the last thing in their inbox in the morning. So yeah, that was the idea.
That's really clever, actually, because I thought, well, Friday, everybody's thinking, let's just forget about the week. And then,
that's Monday. And the morning is when everyone writes the emails and they're cluttered. So you got to go off piste and do the opposite.
Yeah. Contrary opinion theory. Excellent. So just to get a handle on how you analyze the markets and decided on your trades at the hedge funds, or what you included in your research, what's your favored method of analysis, and how did you come by that?
For the blog, I try to think of things. It's difficult because I've had this conversation before. I don't know how this all comes up. It's so in marketing, you're supposed to know your customer and what they're interested in. I really just kind of write what interests me. I try to think what's contrarian. I'm always looking for what things in the market do I not agree with, and write about that. I try and write about things where you can make money, because I always think sometimes I don't like it when I just kind of read a blog or something and I go, okay, well, I had this guy, this is based on this guy I used to work for, this hedge fund guy, right? And he was super street smart and he's very, very wealthy. But he didn't pretend to be incredibly brilliant, although he was. But I would come in and tell him some theory and some big idea I had, and he would kind of just listen to you and he'd go, oh, wow, that's amazing. And he goes, well, what do we buy? What ticker do I buy? And I go, oh, I don't know. So I kind of try to, when I write things, I try to relate it back to, is there an actionable trade here for somebody to do? If there's not, then this might not be something great to write about. So that's a filter. The third filter is I kind of think back to, do you remember that movie Johnny Cash? I don't know if you saw it with Joaquin Phoenix.
Yeah, Walk the Line.
Right? Yeah, yes. And do you remember the scene where he's trying out with the music producer and he sings the boring song and the guy's just like halfway through the song, just like, I've heard enough, thanks, goodbye. And he goes, whoa, what do you mean? How can you say that? And he goes, that, and the music producer goes, do you mean to tell me if you were hit by a truck and you were lying in the street bleeding and you could sing one more song in the rest of your life, that's what you would sing?
Yeah,
right.
It's a fairly high bar, to be fair.
Right, and I know, and you can't do that with a weekly blog, but I do. And then he goes and sings some other song. I don't remember which one he sang after that, but then like the music producer loved it, right? And I try to think a little bit like, don't write fluff a little bit, right? What are the real good things that are important that you would write about that if you couldn't write just I try to like, these are the different things. What would make money? What's different? What are people saying that you're totally annoyed with and you hate hearing about and you totally disagree with? Write that. So yeah. These are the filters.
Well, almost by definition, to be worth reading, it has to be contrarian anyway, because otherwise what you're largely doing is repeating what the herd's thinking.
Yes. So yeah, that's what I try to make it interesting. And I try to write about things that I'm doing and personally investing and so kind of go along with eat my own cooking and not constantly, but quarterly report how I'm doing and what themes I'm doing. And so people know. I sometimes write a lot of different investment ideas. I just want them to know, which one of this stuff does he actually own himself? So I try to quarterly just give people updates on what I own and how it's doing, and be totally open if it's not working, and talk about it and go, wow, I'm really getting beat up on this, and be human about it.
So in terms of that, just to break down, do you use some technicals? Is it all, or some technicals, some fundamentals, no technicals, all fundamentals? Is there any other sort of filters that you use for once you've thought this is a good topic, how you then value it and decide that it's a good buy or it would appear in your portfolio?
Yeah. I'd say I start with, it doesn't have to be this way, but if we were pitching to you as a fund or something, if I was trying to, I start with a filter that I call the factor model, the global factor model. And what I look for, three things. I screen stocks for earnings momentum, valuation, and price momentum. So what I'm looking for is where estimates are getting revised up. And what that's telling you is that there's something happening in that sector that all these wonderful people who know the sector very well and have made 3-year views, something has happened differently than they expected. And so I'm in hedge fund world, I would have also looked at where they're getting revised down, but mostly I'm looking for where they're getting revised up.
Do you have a cut? Sorry to cut in. Do you have a cutoff in terms of market cap?
I do. I think I use 2 billion, but it doesn't have to be. Yeah. So I look for that. Where are the earnings revisions moving up, and globally across 3,000 stocks? Also, what's cheap relative to its sector? So just not, absolute terms, but just relative. If it's a healthcare thing, relative to healthcare, banks versus banks. And then price momentum, I use also just to kind of see, well, is it working? There should be some stock should be kind of working if the earnings are coming in better and it is cheap. If it's not working and it's going down, there might be some data problem that I'm catching rather than, there should be some confirmation coming from the market. So that's the kind of just gets the ideas going. So you can look across the world and see sectors that are doing well. And what's interesting is it's just a quantitative screen. So it sometimes picks up trends that you're not hearing about yet in the media, or it's not a known idea kind of, there aren't all the bullet points as to why it's happening. And it's sometimes very early in the formative stage of it. which I kind of like. And it's also sectors that, if it's shipping, for example, the FT might know. A lot of papers are focused on, don't often focus on some of these sectors. They're not kind of highly things that a wide readership would care about. But they can be really interesting. So, typically papers write about tech all the time, right? But so that's the screen. But then I kind of think about, okay, well, what do I actually do? The thing that hooks me the most, and that screen is great because it gets the ideas going. It makes you look at some sector like shipping that you hadn't thought about, or why are steel stocks doing so well? And I try to go, where do I have like where can I see something a little bit over the horizon that the market doesn't see? And it's a little bit like I have an imagination, I have a view that I can see something 5 years out about how these numbers are actually going to be a lot higher, and this valuation is going to be a lot higher. And to say that doesn't happen very often, but that's when it happens, it's the holy grail for me. And I really try to go heavily on those things. And that one of those recently was the European banks the last couple of years, and that's one of the big themes I talk about in my Substack a lot, and is the European banks, for example.
How did you come to have this type of analysis? Was it what you learned when you were at the hedge funds? Because you were saying that you were, I believe you just said that you were trading the European bank sectors. You were also trading Africa, and those areas seem to feature in your research. So is that information and a form of analysis that you've learned on the job, or was this stuff that you've learned outside on your own, doing your own research in your own way?
Yeah, it's stuff I learned at working in hedge funds. The screening tools, that's something that comes from, investors will ask you, how did your team of 5 or 10 or whatever, how do you have a view on the entire world? How do you know what, you can't possibly read every annual report, et cetera. So that's one of the things, is what quantitative rank tools do you have to inform your perspective and point you where to maybe do more work. And that's how you answer that, right? You say, like, look, the screen pops up ideas, and that helps us know where to do further work.
And you do some coding yourself, don't you?
I do, yeah. I've the last 2 years, one of my latest things has been to get better at coding. Yeah.
And how much? Because obviously you're a team on your own now, so I guess that you lean on that. I'm putting words in your mouth, but I'm guessing you're using that to help sort of fill the gaps of not having a big team, and that allow you to look at lots of data that you possibly couldn't look at on your own, and then filter it down to what you need to analyze yourself.
Yeah. So it's that for that reason, but also I also think about when I'm writing, I'm conscious that I don't want to be just one guy yapping my view, amongst others. And so I think what I'm trying to provide to my readers is also, it's like, here's the data that I'm using I wrote, here's why I'm writing what I think and why I'm having this view. But let me give you the source data so you can poke around and come up with your own thing. So I like,
it's really interesting,
right? Yeah. Cause I think that's way more valuable. I mean, that combination is better. Like, otherwise, sometimes I just read people saying things and this and that. Okay, that's cool. You think this, that, but if you could show me all the analysis and all the data and why that came up as something that I don't know. That's what I kind of find. I think that's one of my things. I think I find useful. I also provide so. The other two things from the investing world. One is the earnings models, right? So I also, as much as possible, try to provide my readers on the Substack webpage. So I have my Substack on a website called www.ywr.world, right? So it's called Eureka. So ywr.world. And on that website, I put the data sets that I'm using, like that factor model I updated every month. I put earnings models on from stocks that I have done work, and I put earnings built, 5-year earnings forecasts and stuff. And the reason is I think that's useful. And sometimes you get into conversations with people and they go, well, I don't like banks, or I don't like China or something, right? And you go, okay, well, or I think there's going to be banks are going to have these credit problems. I go, okay, well, how big a problem do you think it's going to be? Let's talk the actual numbers. They're going to make 200 basis points on the loans. Let's go through to line 67. That's the credit loss assumption. What do you think that number can be? And here's 10 years of it. So how bad is this number going to be? And but and not that I'm being I'm not trying to be argumentative. I'm just saying, look, I think often the great interesting things are when sometimes you do these sensitivities and you go, wow, I could bump this number up by 30%. That was one of the big things about the banks. I realized that the net interest margin expansion was many times bigger than whatever the loan losses were going to be. And that also the perspective was that the banks hadn't been lending for 10 years. So with these things where people say, that's why I've been trying to provide the models as well on the website so people can go in and I go, fine, you think it's going to be really bad, put whatever number your number into that line, and let's have a conversation about where the EPS can still be. So that's the second thing. But then the third thing that it's not really in the data part, but kind of the things I've learned when I look back to things that I've done that have worked out really well for me. It was almost like having that imagination of where something could go over a longer period of time. You can hit a lot of base hits, singles and doubles, like as they're using the American baseball analogy. But the bigger things were where often the numbers were there, but you saw something. I'll give you an example. Because this story stuck in my head and got me thinking. I can't always think. I just, as I said, when you see this type of setup, it's very powerful for me, but it doesn't happen very often. Sorry, I was having some tea.
Yeah, no problem.
So like one of the portfolio managers I worked for, he was telling me a story about McDonald's and some guy that invested in McDonald's and made tons of money. And I don't know if this was back in the 50s or whatever, but whenever McDonald's first started expanding across the US. And this guy, so the guy I worked for was a growth investor. So that was his style, which is not really my style, but it was interesting to work with someone that really loves that. And he said that this investor thought, you know what? Maybe there were 5 McDonald's chains or something. It was popular. And he goes, you know what? I'll bet that there could be a McDonald's in every town that there's a Chevrolet dealership. Right? Every town that has a big car dealership, I'll bet that a town could also support a McDonald's. And this gave him this idea that there could be like 1,000 McDonald's or something. And there were like, I don't know, 5 or whatever it was, 5 or 10. And it kind of got him to look over the horizon to actually how big this thing could be over time, right? And those are the types of things you look back and go, oh my God, if you'd invested $1 in McDonald's. But most people don't ever stay in the trade for 10 or 15 years and make 12,000% or whatever, because you don't know usually, you didn't see where Amazon was going to go, right? Or Apple, so it's hard to have those types of perspectives. But when you do get them, they really can impact your returns. And another one that happened for me personally, but again, I this example of like a positive, but then a negative, is Monster energy drinks, okay? So Monster's been one of the top performing stocks of all time. And when I was looking at it in a hedge fund in 2006, we were in San Francisco, and I was working with this growth guy, right? And this was coming up on his screens of top growing stocks by earnings. And it was actually called Hanson's back then because it was started by some South Africans, and they bought a tea brand called Hanson's, I think it was, but they'd started this energy business. They had also bought an energy brand drink, and it was the energy piece that was growing, but the company was still the sticker was HANS, but the tea business wasn't really growing. But that's just how, now it's obviously been relabeled and retickered Monster, but at the time, it was a big, exciting drink in Southern Cal. We were in San Francisco. It was exciting. Most of the sales were in SoCal. It was kids that were skateboarders and surfers, and they were drinking energy drinks. And we were starting to see them up in San Francisco, up in this convenience stores up in San Francisco. And we're like, wow, like this thing has expanded from Southern California up to Northern California. And we were like what? I mean, do you think it's possible that people in New York would also drink Monster energy drinks? Or is it just too skater culture California, and actually the brand wouldn't transfer? And our big concept was that Monster energy drinks could be sold in New York and it would grow to the East Coast. And so like we made, I don't know, 80 or 100% on that. And that helped us, like, even though it was kind of expensive, 15 times earnings, and there were a couple of wobbles in between, and Kramer got all angry about it because they changed their distribution grid. But we had this perspective that it had a much bigger opportunity set ahead of us. And so we didn't care about the 14 multiple because we looked at, oh my God, if you think of what it could sell in New York, this thing could be. And then of course it goes on now to be everywhere. And my daughter had some friends who she was sleeping over. They were Austrian. And she was visiting their house, and in their bedroom, they had Monster cans, and they had collected the different types of Monster cans. And I was thinking back to 2006 in San Francisco going, we thought it was unimaginable. We were questioning whether it was imaginable, whether someone in New York would drink a can of Monster energy drinks. And here are these 15-year-old girls in Austria collecting the cans. I mean, that's how much it blew up, way past what I expected. So anyways, those are the things that I think that's important for growth investing, because it keeps you in it when there's kind of wobbles and twists and turns along the path. But that's so it's like going back to your thing, it's the screening, the earnings model, so you can really quantify, people, you can have real discussions, and for yourself, sensitivity analysis, analyze things. And then that imagination of where things can possibly go is kind of like the extra sauce if you can get it.
There has to be a bit of luck involved in that, though, because theoretically any product could scale, but not every product or service does. So
yeah, and I don't have a view on a lot of these things, right? Like I know when I don't know, and it's kind of sometimes luck that you might know a product or know something about it, and yeah, those are much more random.
And I suppose I have a question for both of you, which is, let's assume you're on something that is going great guns, and it's going through the roof and it's exploding everywhere. What keeps you in that, given the inevitable sort of swings and roundabouts about outrageous fortune and stuff? What keeps you in the game for theoretically 10 plus years, so that you can exploit the long-term returns, but you also have to survive the volatility? What keeps you in the game for that long?
That's something I'm trying to get better at. And I think because I'm seeing it happen more often. One thing is, I think it really helps if you believe in the founder, or if you like the management of the company. I find if you don't really know, if you're just investing in a company because you kind of liked it and the stock was cheap, and then it goes up 50% or 100, and you go, wow, I think I'm taking my profits. It's hard to fight that. But how do you have a view about where something's going to go over 10 years? It's like Elon Musk, for example, right? I own a little bit of Tesla, and I've been getting beat up by my readers about the fact that I own it. But one of the things I think of with him, I go, this guy it's unbelievable what this human being has done with his time on this earth so far. He has totally changed the entire automotive industry. He has created a new space exploration company that has enabled rockets to land back, land on a pad in the middle of the ocean. I'm like, this is insane what this guy does. What is he going to do in the next 10 years, with the AI at Tesla or the robots he's building? I don't know. and I don't know how to model it. And I don't know if 60 times earnings is the right number for Tesla or it should be 15. But I'm like, this guy has shown an amazing ability to create value and to do enormous things over time in a way that very few people have been able to do. I think I'm going to, even though I'm down 15% of the stock, I think I'm going to actually just hold on to this one. This isn't, you know what I mean?
I think that's a fair response, because I mean, my natural skepticism would say if the CEO just looks like a usual corporate greed head, then there's something very compelling about it. But if he's someone that he or she is someone that seems to be truly visionary, then you give them the benefit of the doubt then.
Yeah, I think it's easier to, right? Like you look at Jeff Bezos and you go, God, I really underestimated what he was going to do over time. And I know he's the kind of guy that wakes up every morning thinking about his business. And also like NVIDIA, and I never knew what NVIDIA was, but I got really interested in Jensen Huang, or however you say his last name, and just his whole story and how and I'm like, wow, that is the real founder story of, and how he saw that Intel was missing the angle on the GPUs. And you're like, that's when if you own something and you see where it's a guy like that, that's very driven, I think those are the ones that are easier to hold on to. I own a UniCredit Bank, for example. And I think the current CEO of UniCredit is a bit like that. So I'm it's helping me stay in the trade longer, and I'm reinvesting the dividends back into UniCredit. But yeah, that's how I think you stay. And also I've done things where I've taken profits, and it feels good when you take the profits and then it goes down a bit. But I found it's very hard to get back in and time the re-entrance. And many times I have sold something for seemed like a short-term good idea, but over the longer perspective, I wish I'd just done nothing and sat through the 20-30% drawdown. And because really what happened was I got shaken. I exited the stock and I never really got back in.
Do you own any challenger banks?
Any challenger banks?
Yeah.
No, I don't know.
The only reason I ask is because I remember a quote from, I think it goes back to the 90s. I think it's even attributed to Bill Gates, which is that banking is necessary, but banks aren't. And it's ever since that moment, and obviously we've had the global financial crisis of 07, 08, and the banks have kind of been a bit messy ever since. But it's always struck me that fundamentally, the business of banking is kind of a commodity business. And I can't speak for the US, but I can tell you that here in the UK, the level of service quality in financial services is by and large abysmal, and the banks are particularly poor. So you don't bank with a bank for good service. Having said that, I quite like First Direct, where I bank myself, but most of the high street banks are awful and notoriously awful for customer service. So there's a whole world out there ready for the taking. We had one challenger bank, Metro, which I suspect is struggling now. But one of the bizarre things they went for is a sort of big high street presence. But if you're starting a bank from scratch, unless you wanted to appeal only to a kind of pensioner demographic, you wouldn't need a high street presence at all, because most people don't need that. They can exist perfectly happily with an app on a phone. So there's all these things swirling around. So I can see an enormous amount of value destruction happening in the banking sector, but maybe not so much value creation, except by maybe some of the new kids on the block. I'm not sure whether you can compare the banking sector in the US with that, say, in the UK, because I'm sure there's lots of sort of regional differences.
No, I guess I was thinking, because like one of my positions is Barclays. And I just look at this company, which is benefiting from rates expanding since they have in 2022. And the company is trading on 5 times earnings, making tons of cash and buying back shares. And I go, yeah, there's, Revolut, and it's fine, and it can gain share and everything. And it's not disrupting them. They're actually, maybe it is in certain business lines, but more I'm just, it's interesting. I guess there's a price for everything. And I've found that the old school banks in the UK are amazingly, to me, undervalued. And there's so many different business lines that they get into, right? They get into corporate lending, FX, treasury management and payments and Barclay card, wealth management. So it's kind of I actually found them. I kind of think there's massive upside in some of these in Barclays Bank, and I suspect that Lloyd's and NatWest stocks might be the same. Whereas I go, this is just stock. I mean, I think as a customer, you're probably right. You know that I like these apps better than my Barclays. But you might find that when you came to the investment side, if I don't think Revolut is, or I don't think there are many listed. I don't know if they're listed on the LSE, these challenger banks. But if it was, it would probably be an amazing story, right? And they probably have charts of the users going up. But then when you go to the cash flows, it would probably be, but we're having to spend heavily because we're developing all the new products we're coming up with, and we're spending $1.2 billion on CapEx. But if you go out to 2027, when we get to 20 million users, it will make some amount of money, and it will be not as expensive on 2028 numbers or something.
But when they finally get around to giving us a banking license.
Oh yeah, well, sorry, you're right, and they don't even have it. But I'm amazed what they somehow operate very well without one. I mean, they seem to do everything. But you're right. I don't think they do. I think they're using someone else's license, right? But anyways, I think that always, like, the story is. It's always tough taking the story of the company and the product back to the valuation and what you're paying for it. And and this is maybe my own bias, I sometimes miss. I'm trying to get better at this, but I have a big value bias, and increasingly wanting to get dividends and wanting to have share buybacks. Especially, that's a new one, share buybacks. I like. Because I think that's worked really well in the U.S. and Europeans are starting to do it more now too.
Tell us about your interest in investing in Africa. Excuse me. And if I could tie in another question to that, the subject of precious metals, base metals, how would you, using your models, how would you value commodities as part of that? Because I'm guessing that your interest in all things Africa are linked to commodities. Obviously, it's very different to shares. What do you use to say that, say, gold or silver or any other metal or base metal might be undervalued on your metrics, and therefore make that particular area interesting from a macro point of view?
Yeah, the reason I got into Africa is not. Is a weird one. Because I grew up in Montana, and I wasn't really focused on Africa at all. But I was trying to get off the south side. I found it incredibly boring, and I wanted to get back to the buy side. But I was like, I'd worked for a hedge fund that had closed down, and I was on the sell side. And so I was having trouble getting back to the buy side position. But a friend of mine was investing in Africa with his own money, and quite wealthy. And he said, I'm doing private equity investments in Africa, and I'm doing public investments. Would you like to run my public investments for me? And also, we can launch an Africa fund with using all my money as the seed investor. So that's how I started in Africa. And we'd been on a couple trips a few years earlier just to kind of look at opportunities in Africa. And he'd gone off to kind of do stuff, and I hadn't. So that we kind of it had been kind of simmering, cooking a little bit. So it was a mix of being interested in Africa, but also like wanting to get back to the investing world, whatever it was. And I remember going, well, I don't know, this isn't exactly what I want to do, but there's that old expression. There was a expression about, you're sitting on the top of this, there's a flood maybe it's an American anecdote. There's a flood, and you've crawled up to the top of the roof of your house, and you're praying to God to send you a lifeboat, right? Or to save you from this flood. And then a boat comes by and goes, "Oh, would you like to get in the boat?" And the guy goes, "Oh, no, God's going to save me." Don't worry, no thanks. You go. And another boat comes by and goes, "Oh, hey, you need help? You look like you're stuck on the top of the house. Oh, would you like to get in the boat?" "Oh, no, don't worry, it's fine. God's going to figure this out." Anyway, so I was kind of thinking, God, maybe like, this guy's offering me to work and start an Africa fund, and here I am trying to get onto the buy side. It's not exactly what I intended, but maybe I should do it. And so that was kind of the twists and turns of life. And so that's where I started investing. That's how it kind of started investing in Africa. I ended up spending 7 years doing it. But going and I actually learned quite a few things about that I've taken back to the tradition, to the developed world from those markets. But it's going to gold and precious metals, because I did do quite a lot of investing in resource companies. And that had also been a big theme of a previous company, a hedge fund I'd worked for as well. So it's turned out to be a big thing I do. The problem with gold is, who knows what the right price is? I have to be honest. And I'm a gold bull, right? And I own gold, ETFs and physical and everything. But I don't know how you're supposed to know the exact right price of gold, right? We can track the M3 versus the gold price, or, whatever monetary metric you want to make, and how much debt's in the US. I don't know whatever fiat money thing you want to put versus gold. The price of gold should be like $1 million by now, right? For the last, from 2012 to 2018 or 17, when we had that bear market, right? And you're sitting through that for 6 or 7 years, and you're like, but I'm honest with myself. I don't know. There's no dividend. There's no way to put a PE ratio on it. There's no.
But you can use ratio analysis against something else, maybe like property or beers or ski passes or really anything that can be expressed in fiat. You can get a ratio analysis for gold, and the long-term purchasing power of gold has been remarkably stable when expressed in property terms.
Yes. But if someone said tomorrow the gold price was $600, I wouldn't have some economic mathematical reason why it should be 2,000 or 600. And same with, I say that to the Bitcoin guy. I would say that to Bitcoin too. Like, I get it. It's bullish. It's a constrained supply, and the money's printing and the whole thing. But that whole story would also fit. It was just saying, the gold guys have sat through, it's very possible that the money supply is going to expand over the next 10 years and your Bitcoin goes zero, doesn't go anywhere. You could have a repeat of what happened to the gold guys in 2013.
Sure.
That is I like the drivers of it, and I'm totally supportive of it, but I do understand that I don't know how you fundamentally pin it to a number. So it's kind of it's the part that can make you uncomfortable, because especially when you translate it to mining stocks, right? Because they're very, they have quite thin margins, or it's getting better, but it was, right. A lot of them will say that their all-in cost is $1,300 or something, but really when you put the taxes and other things in, you find it's more like $1,600 or something. And then you go, sheesh, I better be right. If gold goes to 1,000 and stays there, this thing is going to be a zero. So, which is why these become such hyper beta companies. It's right. It's like, that's why, when gold gets down into those, when it was getting into those, 1,500, 1,400, it was apocalypse for these companies. And it was like, and nobody knew, is it going to drop another $100? Is it going to stay here for 5 years? It was a death scenario. And so on the flip side, when they, we all know this leverage you can get to the upside, where you can have earnings going up, operating earnings going up multiples of the gold price if we go from 2,300 to 3,000 or whatever. So I they're very exciting companies. Over time, I've become a little bit less. I think I'm getting old because I I like a little less life or death with the company and a little bit more, kind of a franchise business a little bit where there's some macro factor that could change, like with the banks, like where if the interest rates rise, maybe I get the same play as the gold, right? But without maybe if there is inflation and we get an extra 100, 200 basis points of rate rises and I can model how that flows down. And I can make a couple X on the banks as well. But you know what? If rates don't go up, if we sit here, they're making tons of money as is. So I have to say, so with the gold and I have shifted. I have become over time less interested in the gold miners, but actually, and I'm saying that probably at the exact, and I've written this too. Could be this exact time when the miners do very well, because you're having gold breaking out. Nobody owns them. They're much more disciplined. They're very careful about greenfield projects in general. They're not even doing many of them. It could be actually a fantastic time for gold miners right now.
And you have the view that inflation's coming or will remain high. Where do you get that analysis from, and how much inflation are you expecting? And I guess, does that actually give weight to buying gold and silver and other base metals based on that?
Yeah. Yeah, it does. And right? So I've done the undergraduate degree in economics, just finished a master's degree in economics. So it's like, I know all the theories and the models, but I also know how things have played out in real life. And I guess what I'm careful before I say that I'm that I think inflation is going to be higher. I'm also aware that it's been an incredibly difficult call. And it was an interesting economics paper by Rogoff, about just that you've had this deflationary trend from the early 80s until, recently, till 2021 or 20. 40 years of deflation. And I thought the interesting part was he went across the different countries, emerging markets, developed markets, countries with exchange controls, he goes, isn't this interesting that we've had a pervasive deflationary trend across the world for 40 years? And it didn't matter if you were running big deficits or not, or within reason, right? There were exceptions, but like Japan, right? We always thought Japan run these big GDP, debt to GDP numbers. It didn't matter. Same thing with after the financial crisis in 08, we ran up the debt, and everyone thought there was going to be inflation after 08, like, oh my God, 0% rates, we're going to have hyperinflation. Didn't really happen, right? So I say it's a really tricky one. And I want to just say that should tell you, and people have been wrong about not expecting the deflation was a surprise to the academics, surprise to central banks, surprise to people who spend all day as their job and have every degree possible know everything about this topic that there is, and they still got it wrong. And so that
sounds about right, to be fair.
You know what I mean?
That sounds about right.
And so I think that as the backdrop of just that this is a very difficult, squirrely topic. And what I think is, I would say, look, with the 2022, and I think inflation went up to like almost 9.5% in the US, and around those numbers for Europe. And if you were like a stock guy, right, and you did charts and trends, you just had a major break of a trend, of a 40-year trend. And it could be a temporary thing, which is what everyone thought, right? But I go,
you can't have that movement again, though. You can't have that 40-year movement from high teens % rates down to zero. Nothing of that magnitude can possibly happen again. So chances are it is a sea change.
Yes, right. And so I think that's signaling something is different, right? But when you look at you're already, if you look at people's forecasts and the Fed, it's all that it's going to go back to 2, right? That was a a one-time thing based on COVID and supply disruptions and whatever else. I think what's actually happening, I think there were what I think, and this is interesting because the Africans will tell you this like without even thinking about it, that inflation is a political effect. It's not a money supply. It starts with the politics. And I was having a beer with a Zimbabwean guy, and I was like, someone else said this, a guy Harris Kupperman, who, kind of, we were talking about this theory, and I was like trying it out on this guy from Zimbabwe, and he goes, oh, absolutely. Like that, it always starts when the politicians mess around. That's when the inflation starts.
Well, in the words of Ludwig von Mises, inflation is a policy.
Mm-hmm. So it is
for Austrian school investors. This has been common knowledge for 100 years.
That makes a lot of sense in the sense that if you go pre the euro and you look at the countries that had the worst inflation and the devaluing currencies, it would have been the ones that had the least stable political situation. So
it would also be most tempted to devalue.
Yeah. So Italy, for example, is case in point. So that's really interesting. So it stems from politics.
Yeah, well, I know, but I want to go a more subtle one on that one, because it's obvious, we always know that governments want to deflate their way out of, problems, as that could be a policy. But another one I think is governments, the more they get involved in the economy, and I think this has been a cultural shift we're going through. Like when you think back to the Thatcher Reagan years, and why did we have 40 years of deflation? I think it was a general trend of liberalization of markets and economies and breaking up of unions and world trade organizations and, globalize it, kind of a lot of let's get the government out of the economy. And I think what happens with that is the economy becomes much more robust and flexible. And, whenever there's a shock, if the price of something goes up, if it's quite flexible, a company will come in and provide a product or do something, or, that it's hard to have sustained price increase, if it's very easy for the economy to adapt to price changes.
If there's real competition.
If there's real competition, right? But then as you start to get the government more involved in things, and every time there's a problem, the government wants to get involved. As you know, there's always those unintended consequences that they never care about, or maybe they do, but don't, whatever, right? And I think this is what's happening. You're getting this layer upon layer of, let's fix this problem and let's get involved and make a rule about this and a policy about that. And then that, of course, creates some other problem. And what we're having is kind of an ossification, like things, it's starting to ossify. Companies are not as reactive. Competition's going down. And just tariffs, all these tariffs, like the chip wars in the US, the EV tariffs. What you're doing is you're effectively giving pricing power to the domestic companies to raise prices. And all these things, I think if you peel policy by policy by policy, you will agree. The energy transition. Who would have thought, right? If you would go back to 10 years ago, you say, we're going to have, I don't know what if the number is 15 or 20% of our energy is going to be from the sun and the wind. Imagine it. It's going to be free. Like the sun is providing us this free energy all day. Imagine how low your utility bills will be in the year 2024. And actually, I think the green transition is quite inflationary, or we're finding it appears to be quite inflationary, and what's costing. So a lot of my point is, I think we're in this era of governments overreacting, involving themselves more and more in the economy, and that is why. And you say, think that's why it is acting more inflationary. Look at the COVID thing. People go, "Oh, there was COVID, and that was a temporary thing." Yeah, but look how you reacted to it. A disease came along that we find out in retrospect was not that, fatal, and yet you shut the entire world down for almost 2 years. So that the way you reacted to this caused inflation. Your reactions to these shocks are what is inflationary. You know, there's always been shocks, but the way you're reacting to them is what's different. You're doing very dramatic things that are causing the car to slide left and right all over the road. And I think we're getting, and you could say, a thing I push back to myself is you go, okay, well, but you know, there's maybe been this trend of the government getting more involved in the economy. And again, an economist would say, well, put some numbers behind that, right? So I don't know how to prove that this policy shift is. I feel it, I see it, but you know, you could push back and say I can't prove it, right? But what I would push, I question myself and I go, but someone would say, why all of a sudden now, right? Why does the CPI chart spike up in 2021 and it doesn't, you know, if this was happening, Erik, gradually, why wasn't it showing up in 2019? And what I kind of think with this, I have this theory of, like, you know, in the physics, they call it phase transitions. And it's when, you know, the water's cooling and, you know, water's cold, it gets colder and colder, and you can swim in it. It's cold, it's unpleasant, but it's cold. But then at 0 degrees Celsius, it flips to ice, right? And it's the same molecular structure. It's the same thing, H2O, but now you can skate on it, right? And you can walk on it. And same with water going, you adding heat and pressure to it. It's, you know, it's in a pot. All of a sudden it can float up and becomes a gas. And what I think happened with 2020, with COVID, is I think we had these trends, but I think something has flipped mentally in the economy and people's minds, how they're reacting, the job market, a lot of things, global politics, about trade wars and stuff, that I think we have shifted the whole. I think we had a trend that was building, but we've had a phase change in inflation, and now we are solidly on the above 2% inflation rate. And it may like get close to down to 3 but I think our next move is actually going to be higher again. Long answer to your question.
No, it's great. It's great. Is it just fair to say then that the economy or inflation is going in a direction, and all the governments do is either attenuate it slightly or amplify it depending on their reaction or policy or whatever?
Yeah, most likely they amplify it. And most likely as the next thing comes along, they'll, you know, next problem shows up, they'll spend money to get out of it or do something, or, you know, yes.
Money's always the answer, isn't
yes.
it? It's always printing money. And I think that speaks to why Tim does what he does, studying Mises and having his portfolio that is a counter to that. What I've learned from Tim over the years, it's a reaction to that constant button that always gets pressed, no matter what the question is.
Yeah. I don't know, Tim, what is your portfolio? Is it a lot of precious metals, or?
It's not 100% precious metals. It's about 99% precious metals with a few base metals thrown in.
Yeah. Well, it's probably doing quite well, and it might be that a real time for you. You know, we've been waiting a long time for this, and it could be I think it could be explosive at this point.
In terms of your you've got some really interesting investment themes. Hopefully we can talk about a few more before you have to go, but obviously it'd be great to have you back on if we don't get round to all of them. But one of them that I'm really intrigued about is how London could be making a comeback. And could you tell us a bit about that? Because how's London gone away? Is it a Brexit thing? Because we were talking about inflation and a lot of people were blaming Brexit in this country on inflation, completely missing the point of what happened over COVID. It's almost like people's memories have been erased somehow, partly because of the way the media have decided to forget all about what the governments did over that period. And but London making a comeback. Tell us about that.
Yeah, maybe I'm reading too much into my own personal change, but I find increasingly that I'm enjoying. My wife and I grew up in Western U.S. My wife is from California. We loved California, And I always found I had to move to London because of work, doing international banks or Africa and the time zone. But I always didn't like it very much. I was like, oh, I'm here for work, but I miss California. So actually, it's my third time living in London, because twice before I've moved back for being homesick. And but I'm finding two things, or maybe three. What I think the US is getting incredibly polarized in terms of political views. And I know this with my friends and family. It is, Tories versus Labor, Republicans versus Democrats is a way more, it's a bigger divide. And it's, I have family members that I cannot talk about any of these. So it's almost, I think sometimes people don't underappreciate in Europe how that level of animosity and frustration that is building up on both sides of this. And what I think with the UK is, I go, you know what? We think it's kind of like we're quite similar, right? But I go, you know what? It's a good thing about the UK. There's a level of civility, the variance, the standard deviations of views and opinions, and just public discourse is in a tighter band. And there's still a lot of the similar themes, but the UK is doing a very good job of keeping within a very manageable. I just like that it's not as extreme in the US. And I go, over time, the thing about the US that's been so great, and you compare it, maybe use an exaggeration, right? There's Japan versus the US. And you go, Japan, conformist society, everyone gets along and nothing happens and it's safe and wonderful. But it doesn't generate the amazing ideas. Maybe the Jeff Bezos doesn't come along, or the Elon Musk, right? So, and you go, the US is like, it takes everything to the extreme, good and bad. I think there's becoming a bad side to this in terms of, I think it's fragmenting. The culture is getting too divisive. And I just say, I think the UK is now appealing globally and to Americans like myself as kind of a version of the US that is a little bit more middle of the road and kind of less contentious. Another thing is on schools. And kind of one of the big things about the US is always, it has the best schools and people, and all this amazing creativity coming out of American schools and stuff. I think it's just getting over the top and expensive, right? I had a daughter go to USC for a year. It was $80,000. I think that's up to $90,000 a year. I think globally, the smartest people in the world are going to start gravitating to the UK. I think UK schools, because the UK schools are the best deal on the planet. You're getting the name brand schools that any Goldman Sachs, Morgan Stanley would recognize, right? The Cambridge, Oxford, LSE, Imperial, UCL. You're getting the St. Andrews, best schools in the world that you can walk into anybody's office and drop these names, and it's 9,000. Or I think for a foreign student, maybe it's 20,000 pounds. So the UK is gonna start to have these most brilliant kids in the world are gonna come here more and more. The third thing, and I think this is related to it, is you're starting to see London as this AI center. And I've come across two different, recent report on situational awareness about AI, and even Elon Musk was saying it. And someone asked him about Chinese AI, and he said, "Oh, do you think China will catch up?" And he goes, "Yeah, there's lots of super smart Chinese guys, and I'm sure they'll get there in 2 to 3 years. But for now, the centers for AI intelligence are London and San Francisco." And I was really surprised. I go, I didn't think London was on the map like that. And then this other, that situational awareness thing said the same thing. And I'm like, this is really big. Because I was there in San Francisco in 99 when, I moved in 97 when the kind of internet thing was ramping. And I saw when I graduated university, I was on the East Coast, and I went and I couldn't get a job on Wall Street. So I went to the West Coast, and I ended up loving it, but it was kind of a failure trade, right? It was like going to the West Coast was not where you were supposed to do. But over my history, that evolved into like San Francisco, what it is now, like this center of tech. And I'm like, if London starts to become an AI hub globally, this place is going to go off the charts again. So, with the great schools, the AI, the just kind of good operating environment that everyone around the world is, you have people from all around the world living here. I was like, this could be picking up again, So that's the long answer, but yeah.
It's a very optimistic take, but unfortunately, rather than use a guarded, rather than use a loaded term, we're having an election today. It seems strongly likely that we can have a socialist government elected in a landslide, which would take some of the gloss off the stuff that you're talking about.
Could it be a thing where they just don't get anything done and nothing bad happens, or?
Well, unfortunately, the scale of the forecast victory is so huge that it'll be a one-party state.
Okay. Well, maybe it's okay. So maybe I got it too optimistic.
But I'd love to think you're right. You're right. And who knows? Anything could happen.
Yeah. Well, the AI, California as a state is terribly run. So, but the kind of the tech piece over, San Francisco and the Silicon Valley are kind of like a little island in the whole country, in the state. So you could have, the things that people and the tech guys vote for, on property taxes and all, it's and minimum wage laws and the Uber, whether drivers should be employees, everything is like not what we would think as like business friendly decisions, but their businesses, their businesses grew so massively that it didn't matter. So just saying, there could be a thing where, you're benefiting from a global, game shifting technology, and people are going to make so much money regardless of the fact of whether there's a, ultra low emission zone or not, or, it could happen even if we're stupid about it. Just to give the California analogy.
I mean, that would be great. I think it would be fantastic if it could survive despite the government, as you're saying. But my caveat to all of this would be that American companies have got a history of having great imagination for what works, whereas in the UK we've invented technology that has been just bought up by Americans. They get it, and they get it fast. So if we start to become an AI hub for whatever reason, whatever companies start to be created, I could imagine American companies coming out with their checkbooks and buying them up pretty quickly, and they wouldn't really take root here.
Yeah.
So that because that's been the history of it.
Yeah.
I think there is culturally a big difference, and I think that comes down to what you were saying with education. Although again, this is really general terms, and I could be completely wrong about this, but I get the impression that it's just the way you're taught to be more ambitious and risk-taking in America, where we're taught more, or the culture's more of being reserved and careful and cautious, and money's not to be flaunted, whereas that gives a much more of a risk-taking attitude to American companies, that when you have a bull market, it pays dividends. Literally.
Just to seize on one tiny point in what Paul's just said, financial failure, i.e. bankruptcy, is still something that people would be ashamed of in the UK, whereas it's a badge of honor amongst American entrepreneurs. It's just like a speed bump.
Yeah. No, a lot of what you're saying is right. I mean, it is a cultural difference how aggressive American businesses are, and culturally in school, and I tell my kids about it too. It's interesting. I was at the AWS summit in London, and there was an American lawyer who works here in London, and he was telling businesses about, businesses that wanted to expand into the US, and he was just being very careful. He says, you have to be very careful before you do it, because it is an incredibly competitive environment. in a way that you're not going to be used to. And if you don't exactly know your product market fit and how you're going to compete, you're going to lose a lot of money and get wiped out. But it is, it's he was, so it is a really competitive culture. It is very risk taking. It is not it's not great to be bankrupt, but it's not, you're right, it's not the end of the world if it's happened to you. And some people kind of, you're right. So that, but we could still have London go have a bull market and all of that,
Oh, sure. I mean, I hope so. It would be very interesting to see.
Yeah. Well, we can have it as a possibility, and we'll just kind of look and see if the data points start to align that way, right? We can kind of like a thesis that we can test.
This is all part of a continuum. So you've got, let's say, San Francisco or whatever on one side, and then you've got London, and then you've got Paris, and you've got Italy, and the work ethic is, let's say, not entirely equal in all of these places.
Yeah, but maybe some people would say, maybe some US companies will go, you know what, I kind of like my UK workers a bit more. Maybe there's a few less eccentric geniuses. But you know what? They come to work and they don't argue with each other and get into battles over Trump, over Biden in the office, and hate each other and then sue each other. And maybe it's like there's some company going, gosh, you know what? Actually, we get more done in my London office, and there's less politics and fighting over gender pronouns and whatever.
Well, that's coming. You see, the thing is, I think you guys are ahead of the curve. Whatever you do, we end up adopting a few years down the line. So there may be a sort of Goldilocks period where we will appear to be better, but depending on the direction of travel, we tend to follow you.
Yes, but I think you go the same direction of travel, but if the US goes to a 10, the UK goes to a 7. It doesn't, and I think this is the inflection point, is that I think some of these cultural things that we've been slightly, but it's the conservative part and the being more careful and the being more kind of slightly fitting in. And my daughters have been going to school here. So it's interesting to me to see the education system, right? And how this kind of and how it, I watch it and on the one side, I'm like amazed at, I think the UK education system is fantastic, even at the public school level and at the, compared to what I'm amazed what they know at 17 versus what I knew at a high school in the US. But then there was one comment. I was at a parent teacher interview, and my daughter apparently was answering questions just too much in class. Like she, does anyone know where this, she'd pop her hand up like immediately, everything.
Oh,
right. And the teacher was like, okay, do you know the story of Winnie the Pooh and the characters in Winnie the Pooh? Right. And she's like, I think so. And she goes, okay, there's this donkey called Eeyore, and he, you're a little too much like Tigger, and it would be great if you could just be a bit more like Eeyore and just kind of not try to answer all the questions so much and give other kids a chance. And I was like,
right.
I get that, but that would be, in the US, that would be unimaginable to tell a child who's like just being overeager and enthusiastic.
Could you be a bit less impressive,
dial
please?
It back and kind of like get back and you quiet it down a little bit? I mean, I told her when I said, don't worry, like totally ignore that. but I was like, that was just like, I mean, I don't want to like overdo it from one thing, but it was like kind of like, look, just dial it back a little bit, So,
Another example of that, I was watching the Office. There was a David Brent motivation speech that he did that we found absolutely hilarious, way over the top, really ridiculous. But apparently, I remember when this came out that a lot of Americans couldn't see what was wrong with it, and that was just like it was just hilarious, because for us it was so over the top, really. Ridiculous, and it was funny because of it, but because of the difference in culture, that it just didn't land in America, which is funny in itself. But but then we laugh about that, but then you look at the culture and who's
You look at the results,
look at the difference.
Right? I know.
Well, yeah, look at the difference between the FTSE and the Dow. Look at the difference between the Nasdaq stocks. Look at all the technology that's been invented by brilliant minds in Oxford and Cambridge, and then along come these American companies and buy it all up. I mean, it's just incredible.
Compare Trump to Starmer.
Yeah, absolutely. I mean, it's just incredible, really.
And I have
we need more of that. We need more of that sort of belief in our country, belief in ourselves. You couldn't even put people feel weird about putting a Union Jack outside their house.
So the police will come and arrest you. That's why.
Yeah, it's just incredible. It's really incredible. We have to have more belief in our country.
Yeah, I don't know. I don't know what you do. But you're right. Like, you're right. If you could just take this really good, just dial up the energy, enthusiasm level 10%, it'd be like the perfect thing, right? You're like, it doesn't have to be off the charts ridiculous. Like, there's things about UK culture that are way better and, have their positives versus the insanity of the US. But we would like to, in our little soup or whatever we're cooking here, we'd like to add a touch of what you got going on over there about the risk taking and the energy and, I think that would be, and you're right. I don't know how that happens other than maybe people kind of just watch what's working over there in the US and they bring it, we just kind of start adopting some of it a little bit. Maybe.
Yeah, absolutely. Yeah.
I don't know how you do it as a policy level thing, but it would be cool. But I don't know. You're right. It's important. And I kind of, just on the investing side, you do feel this suck of money to the US, right? And you go, look, the markets are getting bigger. The US has the venture capital, the whole factory of innovation. From the university to the Silicon Valley, to the venture cap, to the private equity, to the best tech markets and listings venues. It's like it's got the whole infrastructure. And that the fact that the US is creating these companies that then go on to do very well and move the indices in such a way that they outperform the rest of the world, it just means more and more money starts allocating into the US. And it becomes this. So you're fighting, you go, oh, I see this cheap stock over here in the UK or Europe, and you go, and that's where I'm like, look, I have no view that I'm not betting on any active manager to show up and buy the shares of Barclays Bank or whatever thing I own in Europe. I want the companies themselves. If you're generating all this cash flow, you need to buy the shares from me or buy the shares. And so that's what I think that's, I think the growth story works better in the US. There's guys that trade growth stocks all day and retail, and retail is also super active in the US. That's another very big difference, is how active people are with their investment portfolios. And I don't think I've got a pension fund here in the UK. I don't think I've really touched it other than an occasional fund selection. But in the US, everyone's got these things called 401k accounts. And most of the time, you can do whatever you want with it. It starts to become a very big pile of money that you can invest as like it's a stock account. It's not, I had one at HSBC that was kind of controlled, but generally so people have like pretty big pots of money to trade with, and they do. And I don't know, maybe it's part of the culture to trade stocks in the US.
Yeah, absolutely. I've been asked more about 401ks from Americans than where to invest money in the UK by UK people, if you see what I mean. So,
oh, really?
It's a very, yeah. So people say, oh, yeah, what should I do with my 401k? And I remember when I first heard the term
UK
in the early 90s, late 90s, early 2000s, someone said, what should I do with, I was on Bloomberg TV and it's presenter said, what should I do with my 401k? And I said, what, you've got 401,000, what you should do with it. I didn't realize that's what it was, right? So yeah, so that is interesting. Of course, you've got the advantage of population as well, 333 million versus our 65, 70 million. And if you want to make something big with a very similar culture, it's better to make it in America because you've got a greater audience in just about anything, whether it's TV or film, music. But I just want to ask a quick question about, you were talking about London being an AI hub, which is the first time I've heard it. And I think that is so fascinating. I'd heard that Israel was an AI hub as well, and a big tech hub that is doing extremely well. Have you heard anything about that at all?
Israel's always been a really good tech hub, and there's been funds that invest in Israeli tech. And I think Kathy Wood has one. But I'm sure they're big in AI as well, but I don't think London will be big, a much bigger deal. Facebook won't move 500 people to Tel Aviv or something like that. Maybe, you know what I mean? Like that kind of, what you see in King's Cross, these offices of Google, Facebook, Amazon coming in. My wife was in Cambridge, and just one of the Cambridge guys who's studying to be an AI lawyer a law degree specializing in AI. And he was like walking, he's like, all those offices are, Samsung has an AI division, AI lab office in Cambridge. So the big, massive global corporations wanting to tap into graduates and research coming out of top math, physics, STEM universities in the world, where we can put an office in an English-speaking place that we're totally comfortable, which is safe, and boom, London fits the bill. Just hoover up. Let's put 1,000 people in London. That's the kind of like the banks came to the UK in the 80s, the US banks. Tech companies, London could. It's early, right? But it would be interesting if it kind of goes that way. I'm like, wow, like what would property, maybe we should be hoovering up property right now. Like, what if this is about to do another unimaginable leg up over the next 10 years as the whole world? And you know what, we talked about the US, right? And I am a value stock guy, but I sometimes have this where we're not mean reverting, but the opposite of mean reverting, like winner takes all, right? And I'm like, what if London and San Francisco just go off? Because that's what's happened in San Francisco. It's just pulled away from, and economists have done analysis of this, of this one economist took, in the 1960s, he looked at Menlo Park, which is near Stanford University, and some other town, I think it was Bakersfield, which is also in California. He's like, oh, here are two towns. Same mortality rate, same level of high school education, same salary, everything, right? And he just tracked how the property prices, wages, how these exploded in difference because Menlo Park became this tech hub and this other town did not. And what if AI is this other transformational thing, and London. And I'm like, that's why I'm hooking in. I'm like, wow, guys in the US that are not the UK, they don't have any reason to say London because they could care, there's no hook that they have a certain view about affection for London, but they're putting it in the same bucket as San Francisco on a technology that could change the entire human race. What if London goes supersonic on this in the same way I saw San Francisco do with the tech side? So anyways, I'm just, sometimes I do the mean reverting. Oh, that thing's expensive. Let's go look at the cheap thing. But you kind of learn, well, actually the real thing that made money was not that you should sell Amazon and buy Bank of America or something. It was that actually Amazon went on to levels that you wouldn't imagine. Yeah. And you know what I mean? It's using that imagination. I'm like, what if the real thing could be what does that mean? Does it mean that actually property prices in the UK, we're all worried about the fact that rates went up, and we're negative about that. And it doesn't seem but actually, what if there's this is going to be one of two places in the world where the most cutting level research. And what if this whole thing about emerging markets, right? What if we're all on this bullish, emerging markets converges? I call this the Elysium analog. Have you seen the movie Elysium, by the way?
Yeah, I have, Damon? Yeah.
Right, where nobody has a job, right? It's the rich people live in this satellite off the planet, and the Earth turns into a slum because basically, what does any human being have to offer that a robot or AI can't do better, right? And so I think of this a lot with Africa. And I go, we're used to what happened in Asia where they converge, right? The emerging markets learn how to do manufacturing and then it becomes advanced. What if with certain places in emerging markets, we don't care if you know how to sew clothes. There's no making t-shirts. There's no making radio sets. Like that's not the path to growth anymore. Like robots are going to do that. What if vast swaths of this entire planet are effectively, it's too late. You've missed the boat. The technology is now evolving so rapidly. If you look at the GDP per capita on the World Bank statistics, look at GDP per capita of high income countries versus low. It's diverging. It's not converging. It's actually the high income is rapidly moving away and low income is barely growing at all. And so if this winner take all would be like, wow, instead of talking about emerging markets, what if it's actually, no, it's winner take all. And the new thing is AI, and it's going to be probably very tightly, the benefits are going to accrue to a very small number of places. And those places are going to go on to unimaginable heights. And the rest of the thing is going to wither.
Yeah, that's a really
totally. I play around with that. Like I do these things in my head where I go down both roads, and I'm like, what if that's going? Like, what if it's like, like that? And then I go, why are we having so many? Why is immigration illegal? Why are we having this pressure? Are the emerging markets? Is this the stress of technology? Because Africa's always been poor, right? And the Middle East has always been chaotic. Why is there so much, and it's happening in the US too, why are the waves of immigration happening in a way that's never happened in history? I guess you go back to the US and Europe, but I go, I don't know, is this the pressure on the, coming of this new like emergence of AI, and is this those little kind of weird side effects you see where there's just no jobs in these other places. Anyways, I go on.
It's really interesting. I mean, with regard to that, what about Japan and their robotics expertise? That could form a really important part of this AI story.
Yes.
And their stock market is going gangbusters.
Yes. And I do my factor model, right? And where I go and I rank all the stocks, the 3,000 stocks. And I look at also which countries are showing. I look at sectors, I look at countries. Taiwan, South Korea, and Japan have been on in the top 5 countries a lot of the months. And I kind of look at it and I go, like Taiwan, I've never even been to Taiwan. I've been to Japan. I was a big Japan, but I go, what if, like I've got this theme, like what if these countries are the new Europe? Like what if this is the new kind of second market outside of the US? Like what if the growth is, chips, it's, circuit boards and manufacturing tools, and just these are the industries of the future, and the companies that do this stuff, electric vehicle motor actuators or whatever, all these like little weird companies I don't know, but maybe these are the future things, and they're increasingly in South Korea, they're in Japan, and they're in Taiwan, they're in Singapore, they're in China. And that's why I'm like, because I, as an investor growing up, right? It's like, okay, I was American, so of course I am very well, comfortable with the U.S. markets. But the next thing was you had to know Europe, right? And I'm like, what if actually, like statistically, I'm seeing that the momentum is actually in Japan, it's in Taiwan. So, anyways, yes, to your say, I think some of these other markets, they're already showing up as like really good. Like, and I'm like, oh, I don't know anything about Taiwan. I maybe need to be spending more time on these markets, because they're statistically showing up that and a lot of the companies I've never heard of, small parts companies that make things that go into, I don't even know what these companies are, but they're manufacturing companies, machinery companies, LED lighting companies, for example, that kind of stuff that you're like, oh, I never heard of it. But it's whatever they're doing is growing a lot. So yeah, I think you're right on that.
That's really interesting. So your models are showing, like flashing up these countries and these individual companies, and you're thinking, I don't even know what that does, but it's really interesting that I'm getting lots of hits in these zones. Yeah.
Yes.
Wow.
And I'm like, what is that? I'm like, then I'm trying to like connect the dots and paint a bigger picture about it, right? And call it like the new Europe, or but yeah, at the data level, it's just like, oh, I look at how many countries out of the top three. I took cut out of the top 300 of the 3,000 stocks. I look at the top 300. I just count what countries are they coming from, and yes, I've been surprised that Taiwan, right? And it's lots of Taiwanese companies that, yes, exactly. Statistics are saying this.
I mean, I guess with AI, we've seen the AI revolution with technology on our phones and data analysis and all that sort of stuff. And there's a software element to it, but there has to be this transition into hardware when it becomes even more useful. And that's where it starts to take people's jobs. I suppose it's already doing that, but there would be more of that. It's not like we're seeing it on the high street as yet. And you're not being served by coffee by an AI robot yet, but that may be what's to come, and that could be where all these parts are being sort of all the tests are being done for projects like that. So eventually, we do see literally, in front of our eyes, technology being used with as AI, whereas at the moment it is all just software based, or mainly software based.
Yeah, but I think actually you're getting at another great point. I think the AI piece is going to be more disruptive, less disruptive to the baristas for now, and more disruptive to the white collar world. Any job that you can kind of do over Zoom. If you were able during COVID to do your entire job over Zoom, that's a very concerning job in terms of AI. Because if it's all computer interface and like that, I think that like a plumber, right? There's no robot that can walk into your house and look at the mess on your floor.
Yeah, absolutely.
But if it is, oh, I update this spreadsheet and then I go over here and make a presentation about it or something. Ooh, I don't know. Maybe maybe one chat GPT away from it could do that. A lot of these. I think that is we've kind of made, it's not spoken, right? But there's been this kind of like, oh, we don't care, white collar workers, we don't care if we export jobs. And that's just the way, we don't care if all the manufacturing jobs go to wherever, China or Asia, because you need to learn how to, everyone that's in manufacturing and has been on the wrong end of this technology change needs to upskill themselves and learn how to do finance and get these advanced degrees and learn, right? And I wonder now, I think the thing is going to swing a little bit back the other way, that I think right now with AI over the next 5 years, it's probably going to hurt the white collar. That the challenge is going to be more in the white collar than in the manufacturing is probably going to do fine. Construction is going to be off the charts in the US. The construction guys in the US are doing unbelievably well right now. They're making money like never before. And I think the white collar might actually be the softer part of this labor force situation.
Well, to that point, jobs that have been widely held for some time to be least resistant to robotization and AI have included accountancy and legal work. And the jobs that have been held as being most resistant have included priest and prostitution.
Where are you getting that data from, Tim?
Private research.
Excellent. Erik, was there anything that we didn't ask you that you wanted to mention in closing?
No, guys, it's been great, and I really appreciate the invite to be here today.
Oh, it's been absolutely fantastic. Thank you so much for coming on. Just before we end everything, there will be, the media picks thing that we mentioned, and just to give you a little bit of time, if you haven't thought of something, I'll ask Tim first for his, if that's okay.
Something I saw a few nights ago, science fiction film from 2021 called Encounter.
Oh, yeah.
With Riz Ahmed, who I think I last saw in maybe Four Lions, the Chris Morris black comedy. But Encounter is a good example of the unreliable narrator fiction, but it's also about basically an invasion of the world by microorganisms that come in sort of parasitical form via the insect world.
Oh, wow.
So I think it's stunning. I thought it was great. I thought it had great atmosphere, great sustained suspense, well acted. There's two child actors in it that do a very good job. They're his sons in the film. It astonishingly has only an IMDb rating of 5.9. I would have given it easily 7+, probably an 8. So I don't know what people disliked about it, but I thought it was terrific. It's called Encounter, written and directed by Michael Pearce, but it's Riz Ahmed's hour. But it's a great atmospheric sci-fi piece.
Oh yeah, 5.9. I see it here. Yeah, okay. Amazon original.
I thoroughly enjoyed it.
Yeah, brilliant. Okay, fantastic.
Thank you. That's a good one.
Yeah. So Erik, at the early part of the pod, you were mentioning films and stuff, which I absolutely love, and relating that to the markets again, which I absolutely love. So I'm detecting you're a bit of a film buff anyway.
I think we all are, right?
Yeah, right.
I just read a book that is absolutely nuts. By Neil Stephenson. He's kind of a sci-fi guy as well.
Is that Snow Crash guy?
Yes, and he wrote Cryptonomicon. And he wrote this book that took me like 2 years. It was sitting on my desk, and I finally read it. 800 pages. Fall or Dodge in Hell, and it is absolutely nuts. You know how like a lot of books and stuff and movies, like within the first 5 minutes, you're kind of like, I get where this is going to go, and I get I'm still going to watch it, and it's interesting, but I this is not going to be like that different from every other movie I've seen. Or anyways, I feel that way often.
Brilliant.
But this book it's basically about in the near future, some tech executives, rich tech guys, tycoons want to live for eternity, and they figure out how to scan your brain when you die and upload it to the internet, basically. So you're going to kind of exist in this afterlife, but it's hosted by servers, and it's kind of the internet. And it goes on from there. And it's this vast, long story about what happens in this afterworld, but at the same time, what's happening back in Seattle with the guys running the afterlife with their servers, and how they're paying for the compute time, and the dead world's growing, and it's just, I'm like, this is a totally different story than I ever would have thought. And this is so creative, this idea of a tech afterworld and how they pay for it back in the real world.
Wow. Yeah.
Yeah. So it was, I thought it was very, very different and creative and unique. And it's called Fall or Dodge in Hell. Weird name, but it's a totally different book. It'll be unlike any other book you've read. So
they'll probably make a film out of it, would you say?
But you know what? But they've done in the past, and they're difficult films to make, I think. There was one with Halle Berry that they did of one of his books. I don't remember which one it was. Maybe it was Snow Crash. It didn't really work as a film. But anyways, the book is good.
Excellent. Well, there's that tech guy, isn't there, this guy who was into tech, sold his company, and then he's now trying to live forever, and he's doing everything. And this is real. This is real. This isn't sci-fi.
Oh, there is a guy. Yes.
Yeah, yeah. And he's like measuring everything he can measure and doing every single thing he can to live forever.
Ray Kurzweil, isn't it?
There's another guy that's trying to live to 120, and talking about what he eats every day and his vitamins, and I don't remember who he is. But
in that regard, actually, my pick was somebody shared this with me, and I thought it was really good. It was everybody knows Brent Huberman and his Huberman Lab podcast. So apologies if you already know all of this stuff, but I just found this particular podcast with Dr. Casey Means about your metabolism, your blood sugar regulation, and all that stuff to be a really great, interesting podcast, like identifying the problems that are in society, and then coming up with some really interesting ideas as to how personally you can improve your own sort of fitness levels. So Erik, before you go, remind everyone where they can find you on Twitter, and you mentioned you've got a Substack, and it's very active. So tell us where people can find you.
On Twitter, it's Erik_YWR, and the Substack is the website is www.ywr.world. So that's probably the best place to go and read some of this stuff. Thanks, guys.
Well, I'm going to pop that in the show notes right at the top, so you can click on that first and check out Erik's work. just to say thank you so much for coming on the show. Obviously, we want to have you back soon to talk more about these subjects because it's been absolutely fascinating. Thanks very much for sharing your time with us.
Thanks, guys.
All the best.
Thanks, Erik.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.